A moving average is a technical analysis indicator that is used to smooth out price data and help identify trends. It is calculated by taking the average of a certain number of past price data points, with the most recent data carrying the most weight. There are several types of moving averages, including the simple moving average, SMA, the exponential moving average, EMA, and the weighted moving average, WMA. Each type uses a slightly different calculation method, but they all serve the same basic purpose of smoothing out price data. Moving averages are used in technical analysis to help traders identify trends, determine potential entry and exit points, and confirm other technical indicators. For example, if a stock's price is above its moving average, it may be considered to be in an uptrend. On the other hand, if the price is below its moving average, it may be considered to be in a downtrend. Moving averages can also be used to identify support and resistance levels, as well as potential trend reversals. For example, if the price of a stock is trending upwards and then crosses below its moving average, it could indicate that the uptrend is weakening and that a trend reversal may be imminent. Overall, moving averages are a valuable tool for traders and investors looking to make informed decisions based on historical price data. To calculate the simple moving average, SMA, of a given set of data, follow these steps. Choose the number of data points to include in the moving average. This is known as the period of the moving average. For example, a 50-period SMA would include the average of the past 50 data points. Gather the data points that you want to include in the moving average. This could be the closing price of a stock over a certain time period, or any other numerical data that you want to analyze. Add up all of the data points and divide the total by the number of data points. This will give you the average of all of the data points. Repeat this process for each subsequent data point, using the previous average as the starting point and adding in the new data point. For example, let's say you want to calculate a 50-period SMA for a stock's closing price. You would start by adding up the closing prices for the past 50 days and dividing the total by 50 to get the average. Then, for the 51st day, you would add the closing price for that day to the total and divide the new total by 50 to get the new average. This process would continue for each subsequent day, with the most recent data carrying the most weight. It's important to note that the SMA is a lagging indicator, meaning that it is based on past data and may not accurately predict future price movements. Nonetheless, it can be a useful tool for identifying trends and making informed trading decisions. Interpreting a simple moving average, SMA, requires understanding how it is calculated and what it represents. As a lagging indicator, the SMA is based on past data and may not accurately predict future price movements. However, it can still be a useful tool for identifying trends and making informed trading decisions. Here are some tips for interpreting the SMA. Identify trends. One of the primary uses of the SMA is to identify trends. If the price of a security is above its SMA, it may be considered to be in an uptrend. Conversely, if the price is below its SMA, it may be considered to be in a downtrend. Confirm other indicators. The SMA can be used in conjunction with other technical indicators, such as the Relative Strength Index, RSI, or the Moving Average Convergence Divergence, MACD, to confirm trends and potential entry and exit points. Look for crossovers. When two SMAs with different periods cross over each other, it can indicate a potential trend change. For example, if a 50-period SMA crosses above a 200-period SMA, it may indicate that an uptrend is beginning. Consider the time frame. The time frame that you are using can have a big impact on how you interpret the SMA. A shorter time frame, such as a 10-period SMA, may be more sensitive to short-term price movements and may be better suited for day trading. A longer time frame, such as a 200-period SMA, may be more indicative of long-term trends and may be better suited for long-term investing. Overall, it's important to use the SMA as just one tool in your technical analysis toolkit and to consider other indicators and factors when making trading decisions.